Good evening, everyone. Time for another silver update. This is the 1 hour chart of silver provided by netdania.com. You can click on the link below. We had a decent rally today. Not really a lot of news to account for that. It's kind of a upside down news cycle where bad news is good news, in the sense that when you get a bad employment number or a bad economic number, then the chances of another QE go up, and so that's probably what accounts for the rally. Anyway, we did have a breakout of this descending trend line. It's not a firmly established line because there's really only the top and this one touch point, but we did get a significant break through that. The level of about 32.10 was clearly breached, and we continue to travel to the next area of breakout is going to be about 33.30. Then we have about 34.50, 35.50, and then 37.50 up here. So a number of points we need to get through. This seems to be kind of a rounding bottom pattern. I can't really give reasons for it, but it just seems to be intuitive that $30 silver is a very strong level, and it's probably going to be very difficult to get through that. You can see the spikes down. There's a lot of spikes down here, 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 sort of one there, where it seems that the selling is met by a large amount of buying. So there seem to be a large number of buyers out there who consider $30 to be a deal in silver, and of course it is. It's well below the inflation-adjusted high, anywhere from 70 or 80%, as I pointed out a number of times. Now, the stock market is rallying, and the recent give back that we've had, kind of an inflation scare. You can see that the stocks corrected, and then they're rallying very strongly. We're going to talk about returns on stocks when we get to the main story of the night, but you can see we touched down to about 12,700. We're back up to almost 13,000. So we've regained about 300 points of a, we'll say 13.3, 12.7, 600. So we've regained almost 50% of the amount that we've given back. That is not what I expected. I expected at least a correction down to this level, and we're not getting that, so stocks may rally further from here. The two that I'm watching very closely are Priceline and Apple. You can see when we look at Priceline that it is now rallying again. Obviously, this chart is parabolic, so it may rally higher, or it may give this back. When you have a parabolic chart, we'll go out to the weekly and look at it. When you have a chart that's gone parabolic, then you can get extensions that go very high very rapidly. Ultimately, it's going to result in a crash. I remember the interview with Jimmy Rogers in the First Market Wizards book. They asked him, did you short gold? And he said, yeah, actually I did short gold. I shorted it at about 650, and we know that it ran to about 850. And they said, well, were you worried about that? And he said, yeah, I was worried about it, but it was clearly going to crash, and I was actually 3 or 4 days from the high. So he shorted at 650, it ran to 850, and then only 4 days later it was going down very sharply. So that's the type of thing you get when you have a parabolic move, and I think that stocks have made that sort of move, and there's probably not too much upside from here, although we have a lot of people counting on that upside. If we look at the long-term chart of stocks, we still have that 14,200 or so high, and it's going to take a lot of heavy lifting to get past that. We may do that if we get some type of hyperinflationary scenario. I want to jump over to the question of the night, and that is from Book Demon, and he asks, "Hello, brother John F. I've been reading the forum and watching your videos for a little while now, but I am still a neophyte in this realm, a short stacker. I don't yet understand all the charts and lines, but I feel that over time I will learn to look what to look for. It's all so new at this point. My question is this: will we always be at the mercy of the so-called financial powers that be in relation to the value of silver? What I mean is, even when the dollar finally collapses, it will be replaced by something else, a new fiat or digital currency, which in all likelihood will still allow certain powers to manipulate the price of silver just as they do now. It seems that more and more people are waking up to silver and precious metals in general. Will there ever be a way that people will be able to deal with each other on an everyday basis in silver without any interference from financial overlords? It just seems that these overlords always find a way to get between those who stack silver and the supposed value of said silver. How easy it would be to walk away from the system and decide for ourselves what silver is really worth, and how it can be used to just plain and simply live life." So, a very good question. Now, the assumption that the powers that be are always going to be in control, it really doesn't have a historical basis. The fiat money system that we have right now, which is a free-floating fiat money system, is really only about 40 years old, from roughly about 1971 or so. The rest of the history of money systems, which go back 5,000 years or so, indicate that all fiat currencies have collapsed and been replaced with something else. Now, it is possible that a new fiat currency could replace the existing fiat currency, but the current silver suppression, it's my contention that the current silver suppression is primarily a Anglo-American suppression. England and the United States, who are still the dominant powers, they're most interested in suppressing the precious metals, and specifically silver, because of the inherent weakness in their currencies, which would be revealed by a significant rise in price. So I don't see any reason why a system that comes along in the future which replaces that would necessarily see a need to suppress the price of silver. There's really no reason why silver is any different than any other commodity as far as the supply and demand for commodities. I think if you just looked at silver strictly as a commodity, an industrial commodity, and took all of the monetary aspects out of it completely, I still think that you would be looking at a tremendous bull run in silver, one that will take us at least to $1,000, just based on the industrial demand and the suppression and the shortage that that's caused. Now, if you add in the remonetization of silver, which I think that silver stackers are slowly accomplishing, then that's just an added bonus to the price of silver. So no, I don't believe that the powers that be have the power that they think they do. I believe that markets are greater than the powers that be, and I think it's been proven through the fall of all of the empires that have existed before this empire, and I don't think this one's going to be different. I may be wrong. This may be the one time when things are different, but it's, at least in my mind, a 90 to 95% chance that it's not going to be different this time, and that the manipulators will ultimately be exposed and the price is going to shoot to the moon. So let's go to the main story of the night. I've addressed this issue before, but it's such an important issue I want to cover it again. This is a story that appeared on Zero Hedge today, and it's a story about the CalSTRS pension fund. This is the Teachers Pension Fund of California, state of California, I'll read a little bit of this and then go into the analysis. Largest U.S. teacher pension fund underfunding increases by $9 billion to $64.5 billion, only 69% funded. While the epically underfunded status of the U.S., by all definitions a Ponzi scheme, whose combined liabilities have a net present value of about $100 trillion, is known to everyone, most can simply shake it off for two reasons. One, it is a number too big to comprehend, and two, by the time the Ponzi blows up, it will be some other generation's problem. Now, I do have to disagree with that. When we look at the acceleration of the retirement of the baby boomers, and when we look at the moving goalpost of the solvency of the Social Security system, we've seen that it has moved much more rapidly than anyone has predicted. So I really don't think this crisis is going to be generations away. I think this crisis is years away. However, it may not be so easy for California's retiring teachers. Minutes ago, CalSTRS, or the California State Teachers Retirement System, with a portfolio of $152 billion as of February 29, 2012, and is the largest teacher pension fund in the United States, reported that its underfunding increased by a massive 15%, or from $56 billion to $64.5 billion, which happened despite the market being relatively flat over the past year. In fact, this is supposed to be good news, as CalSTRS states its underfunding was supposed to be even worse by $4.3 billion. So this is really good news. We wonder how good the news will be to tens of thousands of retiring and retired teachers once they understand that their obligations are only funded 69% and dropping. But wait, there's more. New normal, no new normal. Here is what CalSTRS did. It reduced the assumed rate of investment returns from 7.75% to 7.5%, which increased the funding shortfall by $3.5 billion. In other words, if the market grows at a true new normal of 1 to 2% or worse, is flat over the long run, we wonder if the obligation coverage ratio would be in the single-digit percentage. So, excellent article. I encourage you to read the rest of it and the comments. One of the commenters mentioned the fact that the right-left argument that goes on about funding, especially when you talk about cutting entitlements, you always get the left arguing, well, we waste this much on war and we waste this much on corporate bailouts and banker bailouts. And of course, that's a legitimate criticism. But in the case of the state of California, you're talking about state taxes and state retirement. So you don't have that argument. There's no military funding coming out of this. There's no corporate bailouts coming out of this. This is just one big Ponzi scheme where they've simply promised more than they can deliver. And I wanted to look at the numbers real quick here. If we look at the total, we've got $152 billion, and you can see the number that they give on the retirees. It's down here at the bottom. It's 856,000 public school educators. Now, I would really like it if someone would provide the number of educators who are currently retired and the number that are currently working. That would be the most important figure we want to see, but we don't have that here. So we just have this 856,000 number, and we have this $152 billion number. So just doing some simple math, if we take this $152 billion number and divide it by our $856,000 number, we come up with about $177,000 per teacher, and that's what's in the fund. Now, like I said, I don't know how many are retired and how many are still working, but let's just work with this number. Let's take this 177,000 and multiply this times a decent return rate, which I would say would be about 5%. That's certainly more than any government treasuries or any CDs or anything are paying, and maybe the stocks are going to return that. But when we do that, this is the number that we get. That $177,000 per teacher is going to yield us about $8,000 a year. So my guess is that the teachers that are retiring right now are not expecting to live on $8,000 a year. It's going to be a significant multiple of that number, and the money's just not there, and the returns just aren't there. So I want to show you the breakdown, because I went to the site. This is actually the CalSTRS site, and there's a lot of information on this site. Unfortunately, there isn't the information I was looking for. If anybody can find it, I'd appreciate it, which is the number of retirees versus the number of current workers. But we do have a breakdown of the current investment portfolio. This is the latest figure. This is the figure they were citing with $152 billion. There's your figure. And you can see that the largest percentage of this retirement fund is global equity. The next is fixed income, and then we have real estate, and then we have private equity. So those are your four categories. Those four categories amount to 97% of the assets of this retirement fund. So the equity markets represent more than half. So let's just do some simple math based on the equity markets. We'll just take the Dow as a simple example, and we'll just use the round figure of 13,000 because that's about where we're at. So if we take this round figure of 13,000 on the Dow, and we're going to assume that it's going to increase by that 7.5% that they assume it's going to increase by, so we'll multiply times 1.075. So based on that assumption, next year we should have a Dow of 13,975, 15,000 second year, 16,000 third year, 17,000, and we'll go out 4th, 5th, 6th, 7th, 8th, 9th, and 10th year. So we're looking at a Dow Jones Industrial of 29,000. That's the price the Dow Jones Industrial would have to be at if the assumption of 7.5% returns held year after year after year. So it's pretty obvious that that's not going to hold. Now, I pointed out in other videos before that this number is very interesting because if you remember the judge in the Bernie Madoff case, he actually made a statement that you can look at consistent year-over-year returns, and once you have a return year-over-year over a certain figure, and I believe, don't quote me because I may be wrong, but I believe the figure the judge gave was 8%. So we're very close to that. And what the judge said was that if you have an investment that returns 8% consistently year after year after year after year, then you by definition have a Ponzi scheme because no investment can return that. So I find it fascinating that in this day of very, very low interest rates and essentially flat stock prices, we still have CalSTRS coming in with an assumption of a 7.5% return. So this is clearly a Ponzi scheme. There's no way that it can hold, and I don't believe there's any way we're going to 38,000 in the Dow. And if by some miracle we go to 38 or 40,000 in the Dow, then you're probably going to see silver and gold. You'll probably see silver at a few $100s an ounce, and you may see gold at thousands and thousands of dollars an ounce. Either way, there's just not enough money to pay for these retirements, and the system is going to go bust. So your only protection against these sorts of things is to stack physical silver and gold, something that's going to protect you from the hyperinflation that's coming. And then when the new system comes out, whatever that is, it will allow you to transfer your wealth to that new currency and then buy some real assets. And we'll talk to you next time.